Let's bring in Kevin Green, senior markets correspondent, right away to help set up the action today. All right, KG, I feel like today's futures action doesn't really tell the tale of the tape, given the context of the Fed. So let's get into it. Let's talk Fed first. The decision was not a surprise, but after that, it's about what the Fed chair says. What are some of your takeaways?
Yeah, so obviously we saw the Fed actually cut by 25 basis points in December. It's going to be the last cut for 2025 here. And their outlook moving forward was actually very interesting, Diane. They're really only pricing in one 25 basis point cut in 2026 here, but they are making some adjustments to their balance sheet where they are going to start buying $40 billion worth of Treasury bills just to ensure that liquidity is going to be ample within the market. Now, when you're listening to Jerome Powell and his commentary, he's a little bit more concerned about the labor market, and rightfully so. Some of the data over the last couple of months has been a little bit mixed, and he actually does believe that we have seen a loss of around 20,000 jobs per month pretty much since April here. So obviously there are still some concerns when it comes to the inflationary front. You see that with the dissents, but overall you actually did see a muted, maybe a more dovish than hawkish tone coming from Jerome Powell, even though, once again, we are going to stop or pause rate cuts, at least for now. But it does show that they are flexible when it comes to QE policy potentially moving forward. Now, buying the T-bills is not QE. I hear that kind of being floated around. I think the market's optimistic that they will resort to quantitative easing, official quantitative easing, in the event that we do see further cracks in the labor market, or we do see maybe some lack of liquidity when it comes to funding markets, especially for large corporations.
Okay, so when we look at some of the takeaways in terms of the, so I know you're saying it's not quantitative easing, but let's go back to some of the Fed's commentary, talking about the discussions at the table. He called it thoughtful and respectful. The decision obviously broadly supported, but there was some dissent. Now, what's the read through, especially when you think about the summary of economic projections to next year? Seems like January is off the table, certainly, but beyond that, is it about the next Fed chair?
It is about the next Fed chair, and then also looking at the growth possibilities for 2026 is also something to keep on your radar. If you kind of go back and look at the March projections that we had, which is kind of the first real summary of economic projections that we had in 2025, they pretty much hit the mark on all of their projections outside of GDP growth, and so they actually kind of re-rated that a little bit more to the upside here. Not too concerned when it comes to the employment rate, at least for now. They did see a little bit of a small adjustment here, but you are seeing a setup for the next Fed chair. Now, you talked about the dissents, and there were a significant amount of dissents if you're kind of looking at the makeup here. Obviously, we had Goolsbee dissenting for this rate cut, did not want to see a rate cut. You had Myron that wanted to see 50 basis points, and you also had several Fed members that actually did not vote at all, and that was actually very interesting in some respects here. So was it contentious? It doesn't sound like it was contentious, but there's definitely a bifurcation when it comes to the views and the outlook of the U.S. economy in 2026, but it appears that the outlook is more concerned about the labor market. It seems like everybody's on board with that. It just depends on how they actually want to address that, and if they are seeing really fundamental cracks in the labor market, at least for now, to really justify a cut going into the next year. Because once again, you're seeing a rate cut like we just saw yesterday on the backdrop of unemployment rate sitting at around 4.4%. That was their target for the remainder of the year this year, which is great. But you also have GDP growth that's really outstripping or outpacing their expectations. Now, some of them may have also calculated into the fact, those that want to cut rates, that the GDP growth that we are seeing is not consumer driven. A lot of it, 60-70% of it, is based on the AI trade just in general here. So you are seeing a little bit of a distortion, but this sets up the market fairly well for 2026, at least for now. I think the long end of the curve could be the big question mark, though, Diane. Do you really want to see, or do you actually see some traders demanding higher yields for the duration that they are taking, 10 years, 20 years, 30 years, given the backdrop that we might see some favorable cuts for next year and even QE for next year?
30 years is a long time to wait for, to your point, any kind of a return. All right, so let's get into Oracle's results. It's under heavy pressure in the pre-market, and it seems like it's about, obviously some key components here, cloud revenue, infrastructure revenue. What's your takeaway?
Yeah, well, if this was a basketball game and Oracle just had a fast break, they just missed the layup. It was a really bad report if you're kind of looking at the expectations for this quarter, as well as the commentary on the conference call here. The company did miss the revenue estimate here, coming in at $16.06 billion. Street was looking for around $16.21 billion. Now, the adjusted earnings per share did actually beat at $2.26. Street was looking for something that was a lot lower than that, but that's because of a one-time adjustment, a positive adjustment, because of a sale of a company that they had within their portfolio of around $2.7 billion here. But their guidance moving forward actually did come in lower than the street's expectations. If you're looking at Q3 guidance, they're looking for adjusted earnings per share between $1.64 and $1.68. Street was looking for $1.72, and their revenue forecast for growth is between 16% and 18%. Street was looking for 19.4%. So both missing top bottom line when it comes to their guidance. And then they did re-rate their CapEx spend higher. They're actually going to adjust that CapEx spend to $15 billion higher than what they previously estimated here, which also once again shocked the street. Now, they want to continue to buy GPUs. They did call that out within the release yesterday. They want to buy these GPUs from Nvidia, as well as maybe looking at some other suppliers. But the market is concerned that, one, they do not have the free cash flow in order to fund a lot of these projects here. They're going to the debt markets in order to do so. And the more CapEx spend that you have in order to get these data centers up, the longer it takes in order for you to actually make a return on that investment, which also, once again, kind of eats into margin. So not a really great report when you're looking at Oracle. Obviously, the stock's down about 12% right now. And the market did feel the effect overnight when you're looking at the futures. You are starting to see it kind of getting bid up at this point in time here, maybe negating some of the issues that we are seeing from Oracle. But it is something to keep on the radar. It seems like that AI trade or that concern around CapEx spending for some of these cloud players is starting to creep back into the market.
Okay, and then you mentioned Nvidia. It's under a little bit of pressure. Is this really all about just the kind of spillover from Oracle?
Yeah, I believe so. When you look at Nvidia's price action yesterday before the Oracle announcement, it really wasn't doing anything. So maybe there was a concern about the Oracle earnings announcement and impacting the AI trade. But you are also seeing a broadening out of this market as well. You did see the stock kind of sell off here a tad bit. It's only down about 1%, 1.5% right now in pre-market trading. But keep your eye out on this price action. It has been able to hold this 180 level, and it has been consolidating for a considerable amount of time. So maybe some buyers really do try to step in here and try to move the stock higher. But Nvidia, once again, kind of seeing that forecast and that outlook, and Oracle talking about spending money to buy GPUs, you actually saw Nvidia move to the downside. It seemed like investors were kind of discouraged about the fact that they're going to get more revenue in the top line here. At least that was the initial reaction. So keep your eye on the price action. It's going to be a major weight in the S&P 500 here, but it is consolidating. 180 is holding. If you break 180, Diane, sharply, especially on large volume, that's when you get concerned about the broader equity market here.
Okay, let's talk your levels on the S&P 500 today. What level are you watching to the upside and the downside?
Yeah, wide range, 6,900 to the upside, 6,800 to the downside. VIX is actually crushed pretty considerably overnight, even though we did slide about 1% in the S&P. But, keep your eye out on those levels here. Maybe we're not out of the woods once the equity market does open, but this would not surprise me, Diane, if we go from red to green today. And if we can break above 6,900 and close above that level, you get out of this consolidation pattern. That would be bullish. That would obviously bring us to new all-time highs. If we go back into this consolidation range that we've been in for the last week and a half, 2 weeks, and go to the lower end of that range, I think the bears get a little bit more confidence that they can knock this market down.
If you just a real quick follow-up, KG, you said you wouldn't be surprised to see if we go from red to green. Is that about kind of the seasonality or just the continuation of the Fed-fueled rally that we saw yesterday?
I think it's going to be several different areas here. If you actually look at those lows from yesterday, because I was up for the most part all night looking at these markets, the buying activity that you've seen over the last 2 hours in the volume for the E-mini S&P 500 futures is very aggressive. So probably some short covering activity for the futures traders and maybe some new buyers trying to buy this dip. And you do look at this broadening trade. If AI is not working and we are seeing it consolidate here a tad bit, the broadening out trade actually can be very beneficial for a lot of institutional investors that need to be able to make up their benchmark here, and I think that's exactly what you are seeing. And the Eli Lilly news can also kind of sprinkle a little bit more of that optimism that maybe the healthcare trade can work, the industrial trade can work, the materials trade can work. So I think it's really the composition of the market and this broadening out trade can help us kind of alleviate some of the pain that we've seen from Oracle and from tech just in general.
All right. Thank you, KG. That's Kevin Green, our senior markets correspondent.